Hello everyone, welcome to your retirement newsletter for Friday. Today is Friday the 13th of May, and in today's video I kind of wanted to just talk a little bit about the market again, and I'm going to kind of combine my in stocks this week summary with this video because I believe that that's the most important thing right now. And this article that came out a few days back, where Bank of America says that the bear market is going to continue for another 6 months, that can be kind of scary, as people don't know yet if they should be in the market or if they should be out of the market, or if now's the time to buy or if now's the time to sell, right? So a bear market is pretty much a period where we're probably going downwards and the swings are very volatile. It's a very volatile market. There's a lot of uncertainty when it comes to trading and when it comes to identifying trends. So for those of you folks who want to know where we haven't crashed, or not quote unquote crashed, because a crash would be a quick 10, 20, actually I think it's a 25% change. You can, if you wanted to, you can check the video after you watch this video, because this video is the most important one right now. But I did do a few videos about the stock market and what the last four crashes were, and how long it took for us to recover, and also things that I think are historically important that have kind of played out recently, at least during the 2020 year and 2021 year. So we could have a lot more, we call it choppiness ahead. Also, if you are a technical analysis or a charting technical analysis like I am, you would see that we have a lot of work to do on the bull side, so on the buying side of the market. Even though we have relief rallies, a lot of times those relief rallies are people who are short the market covering their position. What that basically means is the bears, or people who think the market's going to go down, are covering their positions. They're buying back the shares that they sold at a higher price. So that could lead to very, very rapid buys, because they're buying back the shares, and that can cause algos and other people, other large investment firms, to think that the stock market's coming back up, and they buy up as well. So that's what a bear market kind of resembles. It's just a very choppy, violent kind of market. This analyst says we got 6 more months left. Another thing that I wanted to talk about was China. So China had news that they were being delisted and that it's uninvestable, and JP Morgan actually said that they published this article by accident. And today is a very, very strong day for the market. We're up quite a bit. Let me just pull up my screen here. So the FXI is the Chinese large cap ETF. Their ETF is up about 4.3%, which is actually higher than all the other American indices like the Nasdaq, the Dow Jones, the Russell, and the S&P. So they're definitely outperforming today, and it could be because people are risk owning again. They're saying, hey, we're going to try to take on more risk in China. And China's delisting has been going on and off for a very long time. Most people are pretty much, I guess you could call it dull, or they're numb to the Chinese kind of thing, where we're thinking that they're going to delist Chinese equities. And that could be seen because Baba, which is Alibaba, is up 7.25% today. Lots of these companies are up, right? Baidu is probably up a whole bunch too. Baidu is up 8.77%. So a lot of these companies in China are going up. And that's probably because kind of getting an idea of what's going on. The third thing is that retail investors who've piled in when they got the stimulus check, piled in because we were all stuck at home and nothing really else to do other than watch the stock market and watch news. Sports was pretty much all shut down. So people who normally would spend money gambling have looked elsewhere. I'm not going to say that they've been gambling in the stock market, but that could be the case, as they're showing us here. This little Bloomberg screenshot kind of shows us where the, I guess, start of the retail boom kind of happened and where it kind of fell off. So in the last, or in 14 months here, we had the largest selling. So a lot of retail investors are actually leaving. And this kind of signals, and again, the numbers for the consumer strength index or consumer sentiment was released today, and it showed it went down. So that just shows you that people are getting a lot more conservative with their spending, with their investing. So it could mean more, I guess, bad forecasting. A lot of times, people in those CEO positions will talk about forecasting when they do their earnings report. We just went through earnings season. We're still in the middle of it. A lot of the big names have already come out with their earnings, but we're still not completely done yet. But when a CEO or a board gives their guidance for how they expect to do, they are looking at economic conditions in addition to the overall company, how the company is doing, right? So if there's a whole lot of people with money that they're just throwing at anything they can find, we're gonna have a great quarter. If there's people with barely any money who are penny pinching and looking to find the best value or the lowest cost, maybe company won't do so well, right? Even if their internals are perfect, internals are running at 100% efficiency and efficacy, still not going to work right. The company could still falter. So what this article talks about, and again, I'm not I don't take political sides, but this article talks about how Biden is not really helping in the form of business and stock market and just capital markets in general. So the outlook is very grim, and a lot of these CEOs are pushing the grim outlook simply because they are concerned, right? They don't know what the future holds, so they are guiding lower as far as their next quarter sales or their next quarter revenue. So that could also be already programmed in. So let's take a look at this week in stocks. So what happened? Well, the NASDAQ now from its highs is down 32%. That's the biggest since the great financial crisis. Again, you can find out all those things in that video I'm going to link down below. May is on track to be the 7th consecutive month that RV has increased, and that's realized volatility. That means that the VIX, that's the predictor of volatility, that has been correct. So we have an increasing volatility and an increase of realized volatility, not implied volatility, but actual volatility. Historically, it's the other way around, where the implied volatility, the concept or the market's fear is more than the actual fear. But for 7 months now, consecutively, we have seen the market move more than, or at least the amount that people were fearful of. And that's kind of scary, especially for someone who plays or trades options. Options are priced based on not only volatility, but a lot of it's based on volatility. And when you're selling options, you're hoping the prior, before that 7 months started, where the implied volatility is more than the actual or realized volatility. But what happens now is people who are buying options, who are buying the right options at the right time, they are collecting because the volatility is going beyond, or at least at, where the risk is. And that means that the options are priced perfectly, but in most theories with volatility, option pricing and everything, we've always known that selling options is a little bit mechanically more advantageous than buying them. So again, this is something that never happened. Carvana, Coin, Unum, Rivian, and Shop had incredible action yesterday. Rallies. They had severe rallies. And during a bear market, as I said, it's violent upswings and violent downswings. For those of you who may not be familiar with any of these names here, Carvana, Coin, which is Unity, Rivian, and Shop, I don't believe Rivian has made any money. Shopify, they're in probably around 400 right now. They were trading up to over 1,000. Coinbase, the one who I talked about earlier in the video, they were up 400. They were down to like $40 beginning of the week. And Carvana, they went up about 50 or 60% in the matter of a couple days. And that's very, very indicative of a bear market. So one of the very, very seasoned chart analysts that I follow, he's a bear. He likes bear markets. He actually switched to long yesterday. He is now long the stock market for a little bit because he believes that based on whatever he has, he's long. And he could be long for just today. He could be out already for today, because we had a huge rally today. But that's how volatility and bear markets are. They're just choppy. So the best thing to do, and again, always ask your own financial planner, best thing to do is to just stay put. If you don't need the money now from your IRAs or from your accounts that are invested in the market, draw from other sources. Look to maybe if you have a income annuity or any kind of CD, look to pull out money from there instead, simply because the market right now is very, very choppy. And you might sell today thinking it's an up day, and then tomorrow we jump up another 4 or 5%. We don't know. But until we kind of get out of this turmoil, best thing to do is to hold put. Unless, of course, you're at a level where you won't survive if you don't do anything. And then that's up to you and your financial plan. It's not financial advice. And Bitcoin has a positive 0.8 correlation to stocks, which is the highest correlation ever. Normally Bitcoin and stocks, while they move kind of similar, it's never been this similar. It's almost a 1-for-1, meaning that it moves exactly like stocks. So this is the SPX and VIX. So right now the correlation is pretty much intact, which is a negative 0.8. So where are all the VIX, I guess you could call them, all the VIX's panic? Where is all the problems? And that's the problem, really. Normally, if you were to look at S&P 500, the puts, that means you can call it the insurance, that your portfolio, if it goes down a bit, you can sell it at a price that you predetermined by buying that contract, buying that option. Normally the puts are way more expensive than the calls, and it's just something that we've said. We have put skew. All the major indexes fall faster than they rise. It's just how it is. But as of today, they almost are trading 1-to-1, which means that there is equal amount of risk, equal amount of acceleration or momentum risk to either side, which is indicative again of a bear market. So we have more indications of that. Next, though, a yield curve, something I also covered in my video, and granted this video I did back in January, but it's still very, very relevant, as many of the, core issues that I talked about haven't really been chopped out yet, right? We still haven't had all the Federal Reserve rate interest hikes and the buying. We still haven't really fixed all the supply chain issues, and we still are now battling with the oil price issues and the natural gas price issues. So this is kind of where the yield curve, I'm sure we remember the yield curve. The 5-year was above 3% at a certain time. Now we've kind of teed it off where all the yields are kind of in line. Not totally in line, but they're kind of in line. And with the yield priced in already at the Federal Reserve, now we just have to watch them to make sure, or to at least kind of see how much more they're going to give, because as everyone who invests, at least with the price cap M model of investing, as the interest rate rises, the return you have to get from your stocks increases. So if stocks aren't performing well, then why not just invest in bonds, right? Because the yield in the bonds are getting higher. Next, this is a chart of the futures bonds. This is bond price, not bond yield. So the price of the bonds actually are going up, which means the yields are falling down, in, again, a reverse of what has been currently happening. So many times people look at bonds and stocks as the bonds are going up in price, stock market is going down in price. Well, yesterday everything was going green and everything was going red, all at relatively the same time. Yields move with stocks because yields are the inverse of the bond price, and this is the stock of the bond price. As you can see, in the beginning of in January we were pretty high, and then we fell, just like stocks did. So the correlation's not so intact there. So for those of you who have bond positions in your portfolio, you might have been losing on all fronts of your portfolio, which I'm assuming hasn't been very good for your year-to-date performance. Don't look at it, don't think about it unless you absolutely need it, and then it just rests. So what can we take away? The declining bond yields seem to be calling the Fed's inflation fighting bluff. So what does that mean? So the Fed doesn't actually control inflation or bonds. They control components of the economy's kind of, I guess, core functionality, which is said to impact the price of bonds and overall inflation, because inflation and bond yields are determined by market participants, right? The market sets a price for the gas. The market sets a price for the chicken, for the steak, or for the vegetables, right? Not the Fed. What the Fed does is they try and play with the really short overnight borrowing rate for banks to loan them to them, each their partners, intra or overnight, so that they can remain solvent. They can stay in their level of assets to loaned money or assets to liabilities every day. And with that, they hope to, influence the longer term rates. And when the Fed buys bonds, they are injecting cash into the economy because it allows the US government to sell more treasury bonds, which allows more money to enter the economy. Next, the SPY, which is the S&P 500, and the QQQ, which is the NASDAQ, have been trading a lot. The volume has been a lot, which means that we have a lot of volume, which is actually a good thing, because bear markets usually have low volume. Not many people are doing anything. Everyone's kind of just wondering what's going on, or they're selling, like we say, the lemurs, right? Everyone jumping off a cliff, everyone is selling. Next, low skew. So low skew means that I was talking about a little bit earlier, where the puts are usually more expensive than the calls. So in a low skew environment, we really don't know what's going to happen. It could go either way, which unfortunately is a clue, could be a clue to further underperformance ahead. And that means that the markets could continue to slope downwards. And again, with that article from Bank of America, we may be sloping downwards for another 6 months. But after that, as everyone knows, after a huge sell-off, time-wise, we tend to get a huge rally. So even though the crashes and the corrections and all these things happen, bear markets happen, we tend to bounce back. And on an intraday, intra-week, intra-month, even intra-year time period, it can look very scary. But when we stretch it out into the 5, 10, 15-year plan that you folks all should have, it'll look fine. Just like a blip in time and a chance to potentially have bought more. Now I'm going to have a quick tangent here. I I have my degree in finance, and I've always thought it was really odd that we really didn't learn much about the market. We learned about CAPM, which is the capital pricing model for businesses, for securities, for stocks. We learned about balance sheets, about income statements for companies and how to evaluate them. But none of that really matters when you're talking about a day-to-day price, because you can say, hey, a price of this share is attractive at, let's say, $10. But this share could be trading at $100. And you're like, I'm never going to buy that, right? But people do. People are. And that's why the price is so high. And then on the other side, you say, well, if something is cheap, right? How do you even know if something is cheap? When you look at the valuations are all messed up because everything predicting what we're doing now from the economic standpoint is also messed up. So how do you know, right? So that's where you have to be from a trader standpoint, a trader mindset. I'm going to switch to a trader mindset where you have a specific amount of money that you can risk and a specific amount of money you are targeting. And when you reach that target, you exit that position. For example, if you want Apple and you think Apple is going to go 10%, and that's your goal for the year, then buy Apple at whatever it's trading today, and when it hits 10%, sell it all, right? You got your 10%, that's all you wanted. And then on the flip side, if you think Apple is worth the amount it's worth today, but not maybe 10% lower, if it hits that 10% lower mark and your thesis is the same, reevaluate the company again, because either it's a time to buy or a time to sell. But at that point, it becomes a different trade because your initial thesis is obviously not holding up. And that's where a lot of investors fail. They don't have a specific plan. They just buy, hold forever. And while that's worked in the past, if you are someone who is trading in the market today and expecting to enter and exit trades now, that is the kind of mindset you need, a way more disciplined mindset on what to do. Now, I am not a financial planner. I don't have I had my securities license. I don't have that one anymore. So I cannot give advice on buying or selling things, and I would never do it on a video like this. So that said, be smart, be patient, stay small if you are trading. Don't trade away your whole portfolio. And I'll see you in the next video.